Welcome to the Liquidity Event, a show about all things personal finance with a laser focus on taxes, financial independence, and equity compensation. Hosted by AJ and Shane of Brooklyn FI, each episode will focus on a personal finance topic, some driven by news headlines and sometimes driven by listener questions. And sometimes you'll just get two money nerds rambling about what they think is interesting. Just a quick note before we get started, this podcast is for informational purposes only and should not be considered tax or investment advice.
Welcome to the Liquidity Event. I am your host, Shane Mason.
I'm Kody Sherland.
What's up, Kody? And this is episode 182 being recorded on March 25th and airing on March 26th. Reminder to our dear listeners, email us your finance questions at liquidityevent@brooklynfi.com and we will answer them live on the air. We are gifted with a question that we will be answering live on the air later during this podcast. But first and foremost, Mr. Sherland, how are we doing today?
Doing all right. Still in Minneapolis. It's another week, another podcast, another hockey-related injury. Things are great.
I heard you're playing hurt this week. What's going on? What happened?
Oh, I could work just fine. If this were real hockey, like, the NHL, there would be like an injury designation that say lower body injury week to week. Say
so
nothing else.
You got this from hockey? You rolled your ankle playing hockey?
Yeah, I lost an edge in the corner and just went into the boards foot first, which, I mean, you eat it all the time. It's just sometimes your skate blade catches the boards and twists your ankle 90 degrees sideways.
Damn, I am jealous.
It's not supposed to happen, but
I haven't done anything physical in so long. I am so jealous of you getting out there. I never played hockey, but you're in Minnesota. You're in Minnesota, right? You're in Minneapolis area?
Yeah. It's just it's part of the culture here. You get out and you play and drink a beer in the parking lot afterward.
Hell yeah. I think I would have been good at that part of the hockey culture. My sister, speaking of hockey, I think AJ is out for a missing tooth. That's why she's out, which is another common hockey injury. So shout out to Miss Ayers, who's recovering from a little dental oral surgery. So she should be back in the near future, but she's taking a break from the social media posts that are required for doing a Liquidity Event podcast. Because she is trying to wrap up like a 20-year dramatic relationship with her front tooth, which fell out on the podcast a couple weeks ago. So, dear listener, if you want to go see one of the funniest things to ever happen on a recorded video podcast, please look up our YouTube version of the of the Liquidity Event. Into this week's news, we have a couple cool articles. We've got BuzzFeed nearing a bankruptcy after a disastrous turn towards AI. Kody and I are going to talk about our relationship with BuzzFeed employees and the history of that website as it has gone through the ups and downs of its relationship with Web 2.0 and 3.0. We're going to talk about the crypto CEO who became the number one enemy of Wall Street. We've got finger pointing in the face from Jamie Dimon. We've got some snubbing from Citibank and other high-end, high banking CEOs. And then we've got the SpaceX IPO seems to be just around the corner. We've got 8 questions investors need to ask before investing in a SpaceX IPO. And then we got an article from The Information. Apparently, as of this morning, SpaceX has moved forward with filing its IPO. Looks like they're going to be trying to target a June listing for one of the biggest IPOs, not in just tech history, but in all history of United States IPOs. And finally, we're going to wrap up with the enshittification of everything, everywhere, all at once, which is a mashup of enshittification, one of my favorite jargon terms, and the fantastic movie Everything Everywhere All at Once. Highly underrated A24 flick from a few years ago. And then we're also going to dive into a little bit about airports and like what's going on with the drama in the United States. We have a real listener question. So we're going to dig into how to invest $10K per month with a 20-year time horizon and not trying to time the market. So let's start off with BuzzFeed. This article talks about the turning point for BuzzFeed. Apparently, BuzzFeed owns. Did you know this, Kody? You probably eat hot wings. Did you know that they owned First We Feast that does the Hot Ones YouTube series? I did not.
No, I had no clue. No clue.
I did not know that. I've done that to my friends a couple times where I've just shown, I've snuck into their house and laid out all these chicken wings and had a camera crew there and forced them to do a Hot One series with me. It's a great way to prank people. But apparently they're trending towards bankruptcy, and they had to sell that unit. They got $80 million for it, which cut their debt load from like 130 million to down by 80 million. But apparently they made a disastrous turn towards AIing everything in their journalism stack, so to speak, to cut down on expenses. And that's not going so hot. Do you want to talk us through like what's going on with BuzzFeed?
Yeah. When I first saw this headline before I even opened it and read it, the first thing I thought was, okay, so the website that embodies slop decided to invest in slop.
Yeah.
This is going to go great.
Double
and then
slop.
I open it up. The very first sentence of the article says, in January 2023, BuzzFeed CEO Jonah Peretti announced in a memo to staff that the company was making a hard pivot to AI years before the word slop was added to the public lexicon, which was just great. It was like 2 months after ChatGPT got launched, and they're like, oh yeah, we're just going to use ChatGPT to write our BuzzFeed quizzes. And I haven't taken a BuzzFeed quiz in like 10 years.
Man, times have really changed. Yeah, I mean, BuzzFeed was a lot of fun to read. It was a massive Web 2.0 website. Yeah, it looks like its stock tumbled from it went from $3 to $15 on the news in January 2023. I mean, keep in mind this is in the early days of ChatGPT, where it was still like it was hallucinating a lot, and I don't think you could really build a business on it. And that things have changed quite a bit since then. But yeah, the CEO had to shut down I didn't realize that they had won a Pulitzer for its news division. I wonder what they won that for. Maybe like
it was respectable.
I don't know.
Yeah,
it's a shame that's one of the first things to go when you got to look at the bottom line of a company. But I mean, like within the same vein of enshittification, this is a company that has kind of had to enshitify its experience for the sake of turning a corner. It's lost $57 million in 2025, and its stock price is now at 70 cents per share when it used to be at $15 per share. It's quite a fall from grace. We have a lot of clients we used to have a lot of clients at BuzzFeed, and it's been a tough ride to watch the equity compensation swing around in value over the years, and you never really know when you're going to top or when you're going to bottom. And so like, when we talk to our clients about getting out with our, taking some chips off the table and securing a floor to the net worth of the family, this is a use case wherein it would have been a good idea. And of course, the opposite is that the stock doubles or triples or quadruples. And that's usually why we don't recommend people sell 100% of the stock all at once, but we do recommend a staged multi-year Goldilocks, if you can, between 2 to 6 years divestiture from a concentrated position to make sure that your $15 per share stock doesn't ride the wave all the way down to 70 cents, even though your company, who you know and love, has won a Pulitzer. Capitalism is a full contact sport that comes for us all eventually. And we're going to talk about that a bit when we talk about crypto and the banks and competition there. Is there anything else you wanted to comment on, Kody? I know I kind of ate up all of the, sucked up all the oxygen on this topic, but
yeah. I mean, having a trading plan if you're an employee at any publicly traded company is pretty important. I mean, not everyone goes the way of BuzzFeed or the dodo bird, but it does happen. Like, creative destruction is one of the big parts of why capitalism works the way that it does. That's a double-edged sword. It gives us the ability to grow, and it also gets rid of redundancy. And we were talking about this in a team planning meeting a few weeks ago, and someone just pulled up the BuzzFeed page and screen shared it on Zoom, and their ad blocker had completely neutered the website. Like, it didn't even work. And BuzzFeed's probably like, yeah, we need that ad revenue. Yeah, you never truly know. Even if you're a loyal employee at a company, you may not think that you're drinking the Kool-Aid, but you do live and breathe what your company is saying and what you're doing for work. And you probably think that you're providing some sort of value when you're doing that, and you want to get compensated for it. So, yeah, let's come up with a plan of least regret where you can at least pocket some of those savings. And if the stock goes up, hopefully we didn't sell all of it, and you're going to be able to have more to take off the table at that point in time. But Yeah. Talk to your planner.
Right. Right. We got to work. I think, I don't know who made up the phrase, the path of least regret. It might have been me. And I love the outcome, but we need a better name for that, right? Like it is a goal that we're shooting for, because you never know where a stock's going to go, especially a concentrated position. And you are aiming to like maximize happiness or minimize regret, right? And it's almost like a compliance first approach, or like a conservative approach to advising clients. And it is a real way to go about it, but it doesn't inspire confidence to say we're going to take the path of least regret. Right? Like imagine saying that to
Yeah.
like you're teaching a kid, or like he's got 6 different colleges on his plate, and you're like, well, let's take the path of least regret. It's
Yeah. Yeah.
not the most
Don't
hope
apply to
for.
Harvard or Dartmouth.
Yeah, yeah,
Your
a path.
ceiling is Wichita State.
Exactly. Let's ride. University of Memphis, here we come. Cool. All right, let's pivot. I did mention that we have an article about old, capitalism be a full contact sport. We've got old fintech or finance versus new fintech. Here we got an article from the Wall Street Journal called "The Crypto CEO Who's Become Enemy Number One on Wall Street." And we don't love to talk about, we had to talk about crypto for years on the podcast. We don't like to talk about it as much. But it is entering a more mature atmosphere, especially with these stablecoins. And we've talked about how much we enjoy stablecoins as a disintermediary, so to speak, especially with me living abroad. So much easier to move money when they're, across borders, when there is no border. The border is digital. But it looks like the Coinbase CEO, Brian Armstrong, is now trying to offer 3.5% yields on stablecoins. And it's got Jamie Dimon heated up. Jamie walked up to him at Davos recently, put a finger in his face. Jamie is a Long Island Italian boy, but he just rarely gets heated up like this unless he's being recorded secretly in a board meeting. But it wasn't just him. All of the bankers at Davos essentially snubbed Brian, and they're saying to him, if you want to be a bank, then be a bank. If you want to be a money market fund, be a money market fund, but don't try to pull an Uber on us and go around the legislatures or Airbnb and go around the taxation schema and try to compete with them old school way. What do you think about the confrontation in Davos and Coinbase's attempt to move to eat some of the lunch of traditional banks?
Yeah, yeah. It's a funny question. Uh, Obviously, the CEOs of these banks at Davos are like, get out of here, man. We don't even want to talk to you. It's apparently one of them. He tracked one of them down, and she's like, I have nothing to say to you. I'm going to walk away from you now. Yeah. So basically, what's happening here is Coinbase wants to offer 3.5% dividends for people holding stable coins, which are generally like 1-for-1 pegged to the US dollar, right? And they're trying to act like a bank, and they don't want to be regulated like a bank. And I understand why bankers would be like, "Yo, we have FDIC insurance, we have minimum reserve requirements. The Federal Reserve actually like makes sure that we meet certain liquidity ratios. Uh, if you want to be a bank, be a bank." So I get why they're mad. And like honestly, the last time that this country wasn't regulating banks, like you remember the Great Depression, it didn't go well. And More recently, which is not exactly a perfect analogy, Coinbase and FTX are a bit different, but hey, remember FTX? Yeah, they're gone. So yeah, I understand the pushback on it and the legislation that's being proposed right now to allow like a third party like Coinbase to offer dividends on stablecoins. It sounds like Coinbase is probably going to be on the losing end of this in the eyes of the senators who are actually supposed to draft up and pass this bill. So honestly, if you just ask the public markets and investors what they think of that, just go look at Coinbase stock. It's down. Coinbase is down like 10% over the last week. It's down 50% since last summer. It's still way below where it IPO'd back in 2021. So I understand why Brian Armstrong is trying to shake it up and try to make this happen for his business. But
Yeah.
personally, I'm a little bit skeptical of maybe the use case here and the viability of it.
Yeah. Well, I mean, it's hard to argue like with 3.5% on cash, right? Like,
It's great. It would be really great. Yeah. And the
yeah, I
banks
mean,
don't want to see all
even
that cash flood out.
yeah, I mean, supposedly the banks are trying to tell legislators that $6.5 trillion would flow out if they're allowed to do this from an unregulated perspective, and the banks are hobbled by the legislation that you just mentioned earlier. That's a lot of money, but the banks are also paying 0.1% interest on checking accounts, and then
Mhm.
lending it out at 6%. And then you've got, which gives them a massive spread, and the banks are doing an incredible amount. So they've really rebounded since 2008, and they're some of the most profitable companies in the country. But like, there needs to be a risk reward here. Like, what is the risk? They're massively globally regulated. They're very lightly. I mean, they're regulated, but not to the point where they're not turning gigantic profits. They're too big to fail legally. It's written into our legislation that there's like, what is it, a globally important, I forget the term for it, wherein they are allowed to be too big to fail, and yet they're turning these massive margins. So for someone to come in and offer something more modern, more fluid, I could see why we would allow this. I mean, if we could get our clients, Kody, 3.5% on cash and a
Oh, I
checking
would do
like
it all day. Yeah.
immediately, yeah, right. I mean, I guess we would have to talk about FDIC issues, um, but there have been stable coins that have gone to zero. so,
Yeah. Yeah.
I forget the ones like 2 or 3 years ago, there were stable coins going to zero, unfortunately.
Yeah. There are different
But
kinds of stable coins. We're not going to get into the weeds on the differences between them, but at the end of the day, this is really Coinbase pushing on this right now,
Mhm,
and we really just like need to get back to nuts and bolts here. That Coinbase is an exchange. Like,
mhm.
we're talking about the stock price of an exchange that helps people buy and sell cryptocurrency, and crypto is it's pretty swamped by speculation. People are really, for the most part, just buying crypto because they want to see the price go up and they want to make some money on it. They're generally not using it. So, like, just making sure that we're like kind of keeping this amorphous blob, this thing in the corner where it kind of lives right now, I think is important for perspective. Not to poo poo on it or say that it's completely useless. It's just that's the reality of where it sits today. Our clients don't transact in Bitcoin, and God forbid somebody bought pizza 15 years ago with it.
There could be yeah, I forgot about that. Yeah, at any moment there could be a sea change, and people decide that it's not hot anymore, and it could be a tulip situation. Yeah, I'm with you. And there being a concrete use case for these digital assets, um, needs to materialize. Otherwise, we're all going to get tired of this, or enough people will get tired of it that the prices will permanently decrease. But we shall see. Speaking of, damn, I don't have a transition. Speaking of, shit. I lost it, Kody. Lost my transition. We have a big liquidity event coming this summer. SpaceX is moving towards an IPO this summer, which will probably be the largest IPO in the United States, in the history of the United States, in the history of the world's IPOs. And a lot of our clients have skin in this game, tender offers or secondary purchases, or they just hold shares outright. And the headline numbers are looking pretty crazy for SpaceX right now. We got $16 billion in revenue, $2 billion in free cash flow. But they did acquire XAI, which burned about $10 billion in 9 months on only $210 million in revenue. They're making massive investments in trying to catch up to the other frontier models. So that's not surprising. But from a tax and planning standpoint, when can a client comes to you and says, I have SpaceX shares and the IPO this summer, what's the first question we're asking them to get them ready for a liquidity event of this size?
Yeah, I mean, the first thing that we need to figure out is exactly what they have. Like, okay, what kind of options do we have? How much have you exercised? What kind of basis do you have in that stock? If we're looking at incentive stock options, for example, when did we start the clock on those? Are we going to get long term capital gains? We need to come up with a plan. Based on the mix of equity, based on the timing and how much they have, we need to absolutely know what's going to end up happening tax wise and what they're going to end up doing with those proceeds for their own plan. If someone ends up walking away from an IPO with a couple $1,000,000, that's fantastic. But what's the plan for the money? Are you gonna buy a house, or are you going to put a chunk into a 529? Well, you probably need to have a conversation with if you have a partner, that person, and also your planner. I think one of the interesting takeaways from this, that we're expecting an IPO from SpaceX, is kind of the nature of, a company this big with a publicly traded position. Recent IPOs, they get really volatile right after IPO. Like, you don't have to look much farther back than Figma. I mean, when Figma IPO'd, it went over $100 a share and it rifled right back down. And
we're going to talk about that here in a bit. We're going to talk about the lockup periods. Yeah.
So if you're going into this situation and you have stock in a company that's going to IPO, whether it's SpaceX or not, something important to keep in mind is that another recent trend is that companies have grown a lot pre-IPO, and they actually tend to be IPOing it like after like SpaceX, for example, went from 75 billion to possibly 1.75 trillion. That's over 20 times growth in like 5 years. And other companies like OpenAI and Anthropic are doing something similar. Like Anthropic was up like 19 times in the last 14 months, something like that. And if you're just a regular investor who doesn't already have this position, I don't know that going in and scooping up these stocks right after the IPO is necessarily the best idea. It's not because they're bound to go down. It's just maybe you shouldn't expect 10 times growth right after the IPO, because the secondary markets are actually fairly liquid and people have already poured a lot of money in.
Yeah. It's so crazy you mentioned. Yeah. I mean, well, there's a secondary offering, then there's an IPO, right? So we just talked about, you just mentioned Figma, which had a 6-month lockup after IPO, and for employees to prevent, insiders from dumping their stock when it did IPO. And I forget exactly what the decrease was from IPO to that 6 months, but it was so painful. It was something like, it was like 75% decrease in fair market value from its IPO down to when the lockup ended. So there were thousands of employees that just watched their net worth erode away by the markets. And so if you've got a client that can participate in a secondary offering, they may only be able to sell 20%, but you have no idea what's going to happen on the other side of an IPO once. Private valuations are a lot different from public valuations. Private valuations do not have to deal with the intricacies and wherever the wind blows of a public valuation, and like the disclosures are different. And people might be keeping it afloat in an effort to keep the valuation ball rolling. And then, they can just get absolutely decimated by the public markets after they go public. So it's always a good idea to take some chips off the table when you have that opportunity. And it looks like earlier this morning, SpaceX has decided to move forward with filing an IPO with a target of June of this year. There was all kinds of stakeholders lining up to get a piece of it. Morgan Stanley, Goldman, Bank of America, Citi, a lot of international banks are creating a market for it. And there's some unusual items around the IPO. It looks like it's going to be the size of this IPO is going to be around 75 billion. And instead of a typical 10%. Yeah, stop. Yeah, absolutely. Sorry, we're under construction here at the Mason household. We have a $75 billion target raise, which is the largest U.S. IPO of all time. We have a 10% allocation typically for retail investors, but in this case, Elon and company are allowing up to 20% of retail investors to get a piece of the action, and the rest will go to institutional investors. But one of the most interesting things about the IPO coming down the pipeline is that there is not a standard lockup, like I was just mentioning with Figma, and there could be a quote unquote a custom arrangement, which I have not seen much in the past, which would allow people to potentially exit, the insiders to exit earlier. That might spook some people because that could be interpreted as the insiders know more than your retail investor. Let's let the retail investor participate more and buy these shares from insiders. Let's sell them our snake oil of this combination XAI, X.com, Tesla, Elon's roadshow before Elon dies in a ketamine overdose or what have you. I don't know. Kody, what's your take on the upcoming IPO for SpaceX this summer?
Yeah, and the lack of a 6-month lockup. I mean, the very first thing that came to my mind, there was a running joke that we had at a company retreat a couple of years ago. You remember the cash grab?
Yes, yeah,
That's
hell yeah.
probably what. That's what it feels like. It's like, you know what? Everybody in here just wants to dump this off and run away with the proceeds.
That's from I think you should
And
leave, right? Like sounds like a
all
cash
you,
grab to me.
yeah. All of you Elon fans, you're gonna be the suckers that buy it because for every sale, someone's buying, right? That's how public markets work. So, uh, yeah, if all the people who have a shit ton of SpaceX stock just want to get it sold and pawn it off on everybody else, seems like a pretty good way to do it. Is it
Yeah,
worth
it should
1.75 trillion
be
dollars? I don't know.
1.25. I mean, what happens? I joke about Elon dying, but that's a real concern, right? Because a lot of the
Oh yeah,
valuation of this company is wrapped up in one person, right? I mean, you're going to have Robinhood investors investing right alongside Goldman private wealth clients, and it just seems like an unusual. It's kind of meme stocky. No, what we're looking at here. I mean, don't get me wrong. I think SpaceX is one of the most technologically advanced companies that's ever been put together, and I'm a huge fan of Starlink and whatever they're doing with all the things that they do. It's a STEMmy company that I think is going to hopefully take us into new frontiers. But a lot of this valuation seems to be wrapped up in one personality that is erratic. I don't know how to feel about that.
definitely subject to meme-like behavior. Put it that way.
Yeah, yeah, right on. Cool. Well, let's see what we have here. I'd love to wrap up with one of our listeners has sent in a voicemail for us. We can play it now.
Hey guys, question for you. I've got, let's say, about 10,000 a month. I'd like to start investing. My source of fund really, it does come quarterly, but I'd like to deploy on average about 10,000 a month, long term, wealth building. And I'm struggling to get started, especially with the market turmoil and just how I should be going about time. I know I'm not supposed to time it necessarily, but um, deploying the money, and um, have an idea of where I want to go as far as index funds and that sort of thing. But just what do y'all recommend as far as deploying the money once you have a goal in mind of how much you want to invest per month? And, just want to leave it in there for 15, 25 years, something like that, and build wealth. Love the show. Keep doing what y'all are doing. Appreciate you. Thank you very much.
Kody, if you had $10,000 a month to invest, where would you put it? Looks like we've got like a 15 to 20 year time horizon. Not a ton of details besides that they don't want to do it all at once or not at all. Common question, eh?
Yeah. Like the who, what, when, where, why, how. Yeah, I mean, the first thing that I'm thinking about is an important point was made here that this is supposed to be long term in time horizon, 20, 25 years, something like that. The idea is to hitch your wagon to global economic growth because you want this money to be worth more for you in the future than it is today. Uh, as for getting it deployed, if you're thinking about doing 10K a month, because I think the listener said about 30K a quarter or so to be able to deploy, I like the idea of just starting to drop it in monthly, like throw on your Nikes and just do it. Dollar costing into the market, like you would a 401k. You're just dropping money into the market. You're not really thinking about timing it. Occasionally, you're going to time some of those drops really well, and some of them are going to go in right before the market goes down. But in the long run, those small zigzags aren't going to really matter because what really matters is getting time to grow. If we were to fast forward to the end of the week, the market could be up or down a couple points. I'm not sure at this point, right? If we fast forward to the end of the calendar year, the market could be up or down, 10 or 15 points. If we fast forward to the end of 5, 10, 20 years, I'm pretty confident that it's going to be higher than it is now. That's what we're shooting for here. So you're not going to get your even 7% per year. There are going to be years where you get 20, and there are going to be years where you're down a little bit. But the idea is that you want that long term growth. So I would just start throwing it in monthly and make it like a religious. I'm just going to do it regimented on the first or second of every month and just keep doing it without thinking about the market. Because when you start to let yourself think, oh man, the market's had a real run up lately, I don't know if I want to deploy. I'm going to wait for a drop. Well, sometimes that drop of 10% comes after just yet another 20% run upward. And you've just been losing out on money the whole time. The second big thing that I'm thinking about, other than just do it monthly, do it automatically, don't think about it, is what are you actually going to do with that asset allocation? I love the idea of using low cost ETFs. We need to make sure that we're well diversified across a lot of different asset classes. We want to have exposure to US large cap stocks. We also want small cap, international, bonds, emerging markets. Because as we're hitching our wagon to that global economic growth, we don't know precisely where and when that growth is going to come. It's entirely possible, like if we look back at 2025, that international and emerging markets kicked the US's ass. They did. And even if we hadn't seen that a whole lot since the Great Recession, that could keep happening in the future. And when things like tariff news and oil crises come about, we can't anticipate those kinds of things. And as long as you're being well diversified, you're going to have a better chance of hedging that risk and being able to do the marginal maintenance that's required on that kind of portfolio over time, like tax loss harvesting, rebalancing, and just being smart on the margins.
Very well said. Very well, very comprehensive answer. Hell yeah, that's my boy. Hell yeah, work with Kody. Come work at Brooklyn FI. You get fantastic answers like that.
Schedule a discovery call.
There it is. Yeah, I love that. Thank you, sir. The only other thing I'll add in there is that there's a great blog post written by Nick Majuli of Dollars and Data, his blog. He's the COO of Ritholtz Wealth Management. I'm going to give a shout out to a competitor. He's got an article called "Even God Couldn't Beat Dollar Cost Averaging," and he does a reverse engineering of investing for like the past 70 years for dollar cost averaging versus buy the dip. And even if it's called "Even God Couldn't Beat It," because if you were God and you knew where the dip would be and you always invested there, you still lose to dollar cost averaging because of all the dividends and interest you get from staying in the market and the compounding that you get from that. So we'll put a link to it in the show notes for this one. But Kody, you absolutely killed it this week. Thank you for playing hurt today and joining us on the liquidity event. To our listeners, thank you so much for listening. Email us your financial problems at liquidityevent@brooklynfi.com. And finally, you stands can leave us a review if you want to be weird about it. Thanks, y'all.